is it better to use a home equity line of credit for a business acquisition or use an SBA loan? And so this question is valid whether you're trying to buy a business, start a business, buy real estate, for example, for investment purposes, or any of those types of things. And so first of all, I just want to tell you my philosophy on debt, and that is that there is such a thing as bad debt and good debt. Bad debt is when you go into debt for something that is gone and over with in the flash. So using a credit card to buy dinner and then not paying it off is bad debt because it encourages you to spend money that you don't have. However, buying a revenue generating asset can be good debt. For example, if you need a sign for your business and you need to borrow money for your sign, and that's going to draw people in and make your business more successful, that might be a revenue generating asset. My mom's ice cream shop that she ran for years had numerous ice cream machines, and those machines are outrageously expensive. And so borrowing money to buy an ice cream machine is an example of good debt because every time you turn the handle on that ice cream machine, it generates cash. Money comes out of the funnel. Looks like ice cream, but it's really money. And so, first of all, borrowing money to buy a revenue generating asset can be a good plan. I just want you to make sure that you're borrowing the right amount of money and that the asset really is going to generate revenue because sometimes we see people spend money on things and they're just not that sure it's going to work out. And now you owe money and you don't have the benefit. All right. So now that we've talked about that, let's talk about the different ways to get money. Now, first of all, I think that it's important and good for you to keep cash on hand. So let's say that you've got a $15,000 buffer in your account and you have an upcoming expense for $15,000. You could use the cash and pay for it, or you could borrow money. And I will just say this, that if you burn through all of your cash buffers, then you might end up in a situation where you have to borrow money fast. And that usually does not put you in a position to get a good rate. So that's probably not the right way to borrow money. And so I would say make sure that you keep your cash reserves healthy. And in that case, you might be faced with a couple different options. So a home equity line of credit lets you borrow against the equity of your house. For example, if you bought a house in the Des Moines area 4 years ago, and you've just been making the minimum payments on it, you would normally not have that much equity. But about 2 years ago, the equity value or the value of homes in the Des Moines area shot up. And so you might find that you've got a surprise $100,000 in equity that you didn't know that was there or that wasn't there before. And a bank will usually let you borrow against it. And there's two ways. You can do kind of a refinance where they give you a big check and then you can do what you want with that money, or they can give you a line of credit, which basically lets you use a little bit of it here and there. And so this home equity line of credit is that latter. It lets you borrow now and then. Again, people can get into trouble by using this for short-term expenses, like going on a vacation or going out to eat or buying Christmas toys. I don't think that's smart. But if you're buying a business, then you're talking about buying something that's going to be making money for you. If you're buying rental house or a duplex, then this is a different story. And so I think that it could be a good idea. Here's the benefit of a home equity line of credit. First of all, it's fast. You really can't get money faster than a home equity line of credit. The interest rates tend to be okay. They're not going to be the best interest rates, but they're going to be okay. An SBA loan is a really great thing. The way that the SBA works is, and I'm not a banker, I'm not an insider into this process, so forgive me if this is not to the T accurate, but the federal government helps offset the risk that you might not pay your loan. And so the bank might say, boy, they've only been in business 2 years or 1 year or 6 months. We wouldn't normally lend money to them. But the SBA says we will absorb some of that risk. And so if they default on that loan, we'll cover you for, I don't know, 60% or some number. And so the banks will then say, well, that makes it a little bit easier to say yes. So some people who would struggle to get a conventional bank loan might qualify for an SBA loan. And so this is a really nice thing. SBA loans, especially the very popular 7A loans, have as little as 10% of a down payment. So you can come up with 10% cash. Let's just say that you wanted to buy a business and it was going to cost you $200,000. You come up with 20 grand to cover some of your expenses, and then you can borrow 180. I would say if you have the time and luxury to do an SBA loan, do that. And you might find, let's just use this situation where you're going to buy a business for $200,000. You might borrow the $20,000 down payment through the home equity line, or by doing a 401k loan, and then using that for your down payment, and then doing an SBA loan for the 180. And actually, now that I think about it, if that were your option, I would probably do the 401k loan first, because then you're paying yourself the interest rather than a bank. But the SBA loan is going to be better. However, it takes longer. The last I heard, which was in the summer, July, I think, it was taking a minimum of 45 days. And if there was real estate involved, it was going to be 60 days. And if you're buying investment real estate that you are not going to be occupying, you don't even have a choice. The SBA loan is not available. You have to occupy at least more than 50% of the building. So 50.1% would be enough. Otherwise, you're not going to be able to qualify for the SBA loan. But the reason why I like the SBA loan, if you can do it, is this: in order to qualify, you're going to have to jump through some hoops, and they can be a little frustrating. But those hoops are so valuable. They're going to make you do a business plan, and a good business plan. I do business plans a little different. If you need help with a business plan and you don't want the SBA, talk to me and I'll help you. I do business plans backward. But it doesn't matter that much if you do it forwards or backwards, because the end result is, if you work with the SBA on your business plan, it's going to be a good business plan. And having a business plan gives you a much, much greater chance of success in your business. And so I do like the SBA loans. You'll probably also get a little bit of a lower interest rate. I think your best interest rates come from conventional loans, where you're putting down 25%. But if you are not able to do a conventional loan, you want to do an SBA loan, it's going to give you your best rate. And then also, too, those extra efforts that you have to put into getting the loan and qualifying are going to give you a better chance of success in the long term. So, long-winded answer, but that's my suggestion.